This video could make you a lot of money. And that's really not just my opinion. Tom Lee on CNBC yesterday said, quote, "I wouldn't be too worried about the next 12 months. Take a listen to exactly what he's talking about here in this clip.
Is there much left to impress investors heading into next year? Here to take on that question, Tom Lee of Fundstrat. He joins me at Post 9, also a CNBC contributor. Tom, good to see you. Thanks for coming in.
Yeah, great to see you, Mike.
So we can stack up all the positives. I mean, I know you've been kind of in gear with that idea that the economy would power through, inflation would come down, the Fed could become friendlier, earnings are going higher. Big question to me is how do we set expectations for the year to come, given that that's all in the books?
It's a great question because, you know, we have two back-to-back 20% years, and now investors are wondering how much good news is baked in. But if we look at the 2025 environment, it's a great setup because we have a new administration coming in that's maybe pro-animal spirits, you know, a Trump put. We have a dovish Fed, and as you're pointing out, interest rates are kind of calming down after rising. And we know there's still $7 trillion of cash on the sidelines, and I think sentiment's coming back into check. You mentioned that before with the AAII numbers. So I think it's a good setup for investors. I wouldn't be too worried about the next 12 months.
So don't be too worried. I mean, it seems as if there are all these supportive factors, and when you mentioned the 20% up years in a row, history says actually, you know, the following year is up more often than not as well. What do you mean, do you think, specifically by the new administration being pro-animal spirits? First of all, it's true.
Yeah.
You've kind of seen it at work. It seems to pull in that direction, but are there specifics that the market is fixated on that it's going to drive that dynamic?
Yes, I think that the market's trying to figure out exactly how this animal spirits plays out in markets, but I would say we've got a Treasury Secretary that equity markets approve of. We do know that the last Trump presidency cared very much about what stock prices do, and Jeremy Siegel said this is the most stock market focused president ever. And I think that the uncertainty is around trade and the potential risks around tariffs, but we'll have to see. I mean, that's something markets are going to have to deal with it from an uncertainty perspective.
It's interesting to me that, you know, the way the market has behaved in the last several weeks, but even going into the election, was we need to own more cyclicals, we need to own more financial stocks, we're going to reprice this market for maybe a growth acceleration even, or at least maintaining above trend growth. Meanwhile, though, we're only a couple months removed from a pretty big growth scare. Job growth has kind of slowed to a point. The housing market seems pretty locked up. It's kind of interesting how the sentiment has kind of jumped ahead. Is the economic numbers positioned to actually validate that view?
Markets tend to be forward-looking, so I would expect this. I know there has been a recession in durable goods and in housing and auto sales, principally because of high rates, which have made affordability an issue. That's really on the come next year. I mean, I think the spread of 10 years and mortgages should come down, and the 10-year hopefully behaves. And I think if there's more confidence and more supply, I think housing actually could lead this recovery. I mean, I think that's why home builders actually started to act better this week as well.
Yes, they seem very sensitive too to yields, you know, sort of halting their rise as well. I guess the question is, if we believe it's still a supportive environment, then pretty much all the things you can identify would suggest you shouldn't be too worried about next year. The second question is something like the S&P 500 the best vehicle to capitalize on that?
I think investors are still trying to figure this out. We did a survey with our institutional investors and our RIA clients last week. The majority of institutional investors don't think FANG is the leading trade. They're actually betting on cyclicals. But if you look at the RIA world, the majority are betting on FANG. So I think the market is still undecided whether to be long the Mag 7 or the cyclicals. I'm inclined to be more cyclical and bet even on small caps having a very big year next year.
I think you should obviously listen to someone like Tom Lee and take what they say seriously, because especially for Tom Lee, he's been so correct the last couple of years. You don't want to completely discount what he says. And that's one of the hardest things if you're a bear to do. People tend to have cognitive dissonance. What that means is if you get 50 different inputs, and let's say you're bearish and 25 of them are, you know, supporting your bearish thesis, 25% of them completely go against your bearish thesis, you're going to more heavily rely on the 25 that do complement your bearish thesis and kind of discard the other 25 that are kind of more bullish in nature, right? You tend to just let your biases run wild. And I think that's what a lot of people do in markets without even realizing that they're doing it. The moment that you can actually recognize this cognitive dissonance and take your bias out of the equation is the moment in which you will really elevate your trading and or investing. This is something I've personally been working on over the past year or so. I've really started to notice sometimes when my bias has started to affect the way that my outlook has been. And I've been investing almost 10 years now, every single day following markets. And I'm pretty experienced in the world of trading and the psychology of markets. I think that can be equally, if not more important than the actual fundamentals of the markets. That's just really what's priced in, expectations, how markets can be surprised by one thing or another. But really, when I sit here and look at markets through now into year end, there's some things that really stick out to me that are kind of going against what a lot of people, especially the bears, are kind of holding on to right now. One of which I think this is the biggest of all, is everyone says valuations are high. Markets are euphoric. They're unsustainable. And yes, there is some merit to that. On a headline basis for the S&P, it is expensive. And that's one reason why I think the S&P's going to underperform certain areas. That's why I think small caps, mid caps, and cyclicals will outperform. And if you're a bear right now, you likely hear that and say, yep, S&P's expensive. That's it. That's all that matters. But when you look at the internals of our markets, the average stock is trading at average stock valuations, historically speaking, around 18 times next year's earnings. That's not expensive. That's not a historical red flag for future stock market returns. Yes, as valuation goes higher, that tends to mean, longer term returns are going to be lower, at least over the next couple of years. You're not at that point internally in the markets. We could get there if markets get euphoric, and keyword if, because I'll show you in a moment, markets are not euphoric. So what does this mean? The headline S&P is probably not going to do that well next year, but the rest of the markets could. And I think this is likely going to be an underperformance of big tech. As Tom Lee said in that clip, where a lot of fund managers are overweighting is in cyclicals. That is not the consensus call right now. The consensus call is not to own a Dollar General or to own, more cyclical names. That's just not where people are allocating their money. And I do think over the next couple of months heading into 2025, we will get a correction, but I think that is your opportunity to add exposure to the cyclicals, to the small caps, to the mid caps. Because yeah, I got to admit, Apple growing revenue 5% over the last 3 years, trading at 28.5 times next year's earnings, does not look attractive. And I don't think there's a favorable risk to reward there. But an Elf Beauty, for an example, trading at 33 times next year's earnings, growing at 65%. EPS could start to grow over 50% next year. That's very attractive. That is much, much, much cheaper than Apple, even though the headline PE is it's larger. It's growing way faster. And I think that is where really the opportunity lies in our markets. But let me just first destroy the biggest bear thesis right now, that markets are overly optimistic, they're euphoric, they're priced for perfection. Again, yes, on the headline basis, they are priced for perfection, but that does not mean that a broadening out of this market could not continue. I think that's actually the most likely scenario, at least from now into year end. Now, let's talk about euphoric. I think a lot of people have forgotten about how a euphoric market actually looks. If you think this market is euphoric, you have a lot to learn, my friend. And I say that from utmost respect, utmost love for all of you guys that watch these videos. Markets are nowhere close to perfection or euphoric, okay? Euphoric is basically just perfection. You're not. In fact, Tom Lee and Mike Santoli there talked about this a little bit in the last video. The AI Investor Sentiment Survey that comes out once a week on Thursdays that asks investors one question. What direction do AAII members feel the stock market will be in the next 6 months? This is a pretty good indicator, I think better than other indicators for market sentiment, okay? And you might be surprised by this if you haven't seen this so far, but there is more bears than bulls in the reading that just came out November 27th on Thursday. Yet on Friday, the S&P closed at a new all-time high, around $603 for the SPY. On the bullish side, sentiment is 37.1% bullish, neutral is 24.3%, and bearish is 38.6%. Let's say that again. Bearish is 38.6%, bullish is 37.1%, and neutral is 24.3%. Under the surface, people are not that bullish. They're not. And I think part of that has to do with some of the very high price targets we are seeing for 2025, like 7,000 and 6,600, 6,500, right? Pricing in 10 to 20%, headline S&P growth next year. That has people wanting to fade that trade, making people take the contrarian call, because normally when Wall Street is giving out next year price targets that are 10, 20% higher, then usually, that's a sign that markets are euphoric or getting at least close to that. So I think people are taking the opposite end of that trade. And that could be precisely what takes us higher into year end, which is a crazy thought. That Wall Street's bullish, so everyone else is kind of bearish, and that could be bullish. It's crazy. But that's kind of how we are set up right now. Now, again, I will acknowledge, to the bear's point, valuations are high for the headline S&P. If you want to just look at the headline S&P, there is headline S&P risk over the next couple of weeks. 2 dates you really want to mark your calendar for that could upend this bull rally, okay? First, it's the jobs report on December 6th. That is this upcoming Friday of this trading week. And it's December 18th. That is the next Fed meeting. If the Fed says anything along the lines of an extended pause or maybe hiking rates next year if inflation goes higher, that's likely to put a pause on this rally. Anything less than that, you're probably going to rally into year end. The Santa Claus rally is likely going to take effect. Now, I know a lot of people say December is the second worst month for markets over the past 10 years. That's true. It's negative 0.2%, at least over the last 10 years. But it's really just 2 years that skew these percentages. So it was actually 2022 where December lost 6.2%, and 2018 that lost negative 9.3%. And you could also group in here 2015 that lost 2.3%, that really skew these numbers. 2023 was up 4.1%, 2021 was up 4.3%, 2020 was up 3.3%, 2019 was up 2.4%, and 2016 was up 1.4%. So really, bottom line, December either is a really good month or a really bad month. So I think we're set up for what could be a really good month for December, as long as that jobs report comes in good and the Fed does not spook the markets. There's not a lot to really crush the bull thesis heading into December and throughout the month. Now, where I think we will run into an issue is to the bears' credit. I think expectations are high for a soft landing. I think Wall Street's pretty well expecting a soft landing. And I think in Q1, we're going to get some data that does not look as soft landing like. And you will get another growth scare and you will have a correction, but I think that is a very much buyable correction. Because let's face it, markets have done very well under Biden. And if you're someone like Trump that has a high ego, that wants to leave this legacy, I don't think Trump wants to be the guy that came in and crashed the Bulls party. So I think he can only do tariffs to the extent that markets don't react, right? I think you can only see so much as far as, deficit spending to the point where the bond markets react. You can't really do too much without upsetting the markets here. Now, you can give markets positive surprises like deregulation, lower inflation, not as aggressive tariffs. That's my expectation for next year. That's not the consensus view from Wall Street. Consensus view from Wall Street is we're going to have aggressive tariffs. That's an area of uncertainty. Even like Tom Lee said, he said, if there's a problem next year, it's going to be with tariffs. I disagree with that. I think if there's a problem next year, it's going to be with a growth scare that comes in Q1, possibly Q2 of 2025. That's the big problem. Okay. It's not tariffs. It's not inflation. Inflation's going to fall more than expected. And really, overall, I think there's a lot of room here for positive surprises given the negative expectations. And it's kind of wild that we have these negative expectations for, destructive tariffs and, again, higher inflation, a less aggressive cutting regime from the Fed, but yet we have very high expectations for the economy. I do kind of acknowledge that it's unlikely those things will happen in the way that Wall Street expects. So either the economy disappoints or maybe I'm wrong and then we do get destructive tariffs and Trump leaves a terrible legacy from a business perspective. I don't think that is likely though. And that's why I'm ultimately bullish on 2025, but I do think you want to be selective on where you are bullish with small caps, mid caps, cyclicals, some of your value names. I mean, they're trading at very low valuations with what could be a higher pickup in real growth. You could see the lower end consumer start to recover a bit if wages start to pick up and inflation stays low. And that would be a positive surprise to our markets. Another positive surprise next year could be a Fed that cuts rates more than expected as inflation comes down and really shelter inflation that comes down. And to see the real estate market start to move. As long as there's not destruction in home prices, people are going to be selling homes with a lot of equity. And that's going to give them a lot more money to spend. And I think that is a tail event that is not even being talked about in markets right now that could happen in 2025. If that does not happen in 2025, that likely happens in 2026. So I think there's a lot to be bullish on, believe it or not. The only thing I'm really concerned about is expectations for the economy. I think expectations for everything else are too bearish, right? Tariffs, inflation, all that. But the economy does have high expectations, and that's where we could be in for big surprises with certain economic data points. If they come in bad, let's say the jobs report comes in bad, that's going to really catch a lot of people off guards and off sides. And I think that's where the risk really is in our markets. But from now until year end, if that jobs report is good on Friday, which I think it most likely will be, I don't forecast the Fed giving us some kind of black swan statement. That means December could be good for the headline S&P, but even better internally in our markets because you're not even close to euphoria. I think a lot of people have forgotten what a euphoric market really looks like. Just do this simple exercise. Look at the comment section of this video. Okay, a lot of people, they don't watch until this point in the video. So they're just going to give you the raw input of the headline of this video, the first couple of sentences of this video. Maybe after the clip from Tom Lee, they click off and they write their opinion down below in the comment section. Just look at those comments. And if 95% of them are positive, you're likely in a euphoric market. If there's a lot of people that are negative in the comment section that are bearish, you're not in a euphoric market. And that's a pretty simple exercise you can do almost every single day. at least on these videos when they're posted. So again, let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.